Welcome to Behind the Doors, the podcast where we take you behind the scenes of residential real estate investing. I'm your host, Dan Noma Jr., here with my co-host, Marvin Cruz.
We're here to help you unlock the best strategies and practice for investors. Whether you're just starting out or you're a seasoned pro looking to scale your portfolio.
We've spent decades navigating the ever-changing world of real estate, and now we're sharing everything we've learned to help you succeed.
From off-market deals to cash flow management and everything in between, we'll break it down and bring you actionable insights that can make a real difference in your investments.
So get ready to open the door to new opportunities and take your real estate investing to the next level. Let's dive in.
Happy Friday. It's Friday today, Dan. Welcome back, bud.
Friday.
How are you doing?
Good, man. I'm hot. Still hot in Phoenix, man. It's
112 today.
Yeah, I'm hot.
112.
Yeah.
Ladies and gentlemen, welcome back to Behind the Doors. I want to remind you what this podcast is all about. It's uncovering the behind the scenes of what's really shaping real estate investing, right? And today we're going to dive into something that is game changing. So real-time housing data and how ultimately this is completely rewriting the playbooks for investors and agents. Joining us today is Gus Marquez from Parcl Labs. Make sure I got all that right, Gus. A company that's making waves with their cutting edge data and deal flow tools. So if you ever asked yourself, audience, how can I make smarter, faster decisions? This episode is probably for you, because the future of investing isn't in lagging indicators. It's actually happening right now. And so, Gus, welcome to the show, buddy.
Thank you for having me.
Happy to have you, man. So give us quickly the backstory. Who is Gus and what is Parcl Labs all about?
Yeah, definitely. I'm Gus, the head of product at Parcl Labs, as well as Parcl. And really the genesis kind of starts during COVID. Our founders were at a hedge fund. They were basically seeing everybody, the mass exodus of New York and everybody migrating down to Miami. They were really curious as hey, how do I actually how do I financially benefit from all this migration that's happening right in front of us? And there wasn't really a vehicle. And so as they were searching for an investment vehicle, the necessity for data came up, and the existing data providers really kind of provide data on a lag. And the public provider, right, the Case-Shiller index, especially the composite or the individual metros, those are kind of not all encompassing, right? They're 2 months old. They're only single family repeat sales, so they don't include any of the new construction. And so it's pretty obvious to us that there was this opportunity to not only collect the data and to find a way to create an investment vehicle for it, but also to distribute this data and give it to people and allow them to make better decisions with real-time information, right? The Fed says they're data dependent, but they're basing everything off old data. And everybody is really data dependent in real estate. And we think that they should have real-time data.
That's sweet. And then you guys go beyond that, right? It's beyond data. You guys also people can invest with you guys as well, right?
Yeah, that's right. So there's two sides of our business. And so in order to create an exchange to allow people to get access to real estate in a liquid manner, we had to have the data. And so what we've done is we created a synthetic investment vehicle that allows people to genuinely get exposure to real estate in just the asset. So none of the cash flow or anything like that. You actually can say, hey, I think property values in Austin actually aren't going down. I think they will go up. And so on our platform, you can make that investment into Austin, Texas. And if that market were to start going up rather than the correction we're seeing today, you could actually profit from that opportunity without all the headaches of being a landlord. And so there's two sides to our business. There's the exchange where people can get exposure. We've done about $4.5 billion of transactions on our exchange over the last year. And then on the Parcl Lab side, you can get that institutional grade insights of what's happening on the ground, as well as what big portfolios are doing, like Open Door, which has been something that's been very popular as of the last couple of days and weeks.
Yeah, definitely. We should unpack that in a little while. We should talk. We should talk through that a little bit of what you guys have discovered out there. So, thinking about the market today. I mean, obviously you're really close to the data and information. We keep hearing rates are the issue. Are there other factors that you guys are noticing that we should keep a pulse on, that we should have an idea of what's going on with some of these other factors?
Yeah, I mean, rates play a role, right? But the depreciation in home values is pretty dramatic, especially if you compare it to the median income in certain regions, right? And so you get these very, very large dislocations. Miami is one of them, but for some reason, Miami is a resilient market, but other Florida markets are not seeing the same resiliency, like Tampa or Orlando, which are really kind of tough markets, right? These homes have appreciated appreciated dramatically. They're now outpacing income. And so people who are looking to kind of like capture that equity appreciation, they're just unable to offload that home in that inventory. And so, yeah, we're definitely seeing that, rates will play a role. They certainly make the mortgage more expensive, but the mortgage is going to be expensive whether you're getting that mortgage at 2.8% or the 7% that we're seeing today. And so it's really about the appreciation story. Some markets saw a ton of appreciation post-COVID, right? Austin, Texas, a lot of these Florida markets, San Antonio, which we've started to become bearish on. And then you're looking at the Northeast, where a lot of that migration took place from, and we're starting to get bullish on the Northeast, right, in the Rust Belt. And so we're seeing kind of this divergence between regions, where the regions that were winners, post-COVID, are now slowly kind of seeing that migration go back, or maybe some retreat in these home prices. And some of those markets in the Northeast and in the Rust Belt, we're starting to get bullish on them. They're not seeing as aggressive of price cuts. People are not price cutting, as frequently either, as we're seeing in some of these like Southeast markets that did benefit from COVID. So yeah, the story is certainly rates, and rates will play a role as especially as the Fed makes a decision with some of the administration's pressure. But also these homes are very expensive based on income as well.
Yeah, for sure. I was recently up in I was in Montana and Idaho, and I was kind of cruising that area a bit. Idaho, like specifically Boise, was one of these like boom markets during COVID. A lot of people were jumping into that market. And I'm not suggesting that it's like gone sideways, but they certainly don't have the activity that they maybe thought that they were going to continue to get.
Yeah.
And so there is quite a bit of builder inventory and stuff sitting on the market up there, which is interesting. So it's funny to hear that even some of the Northeast markets too, where people left, are now maybe going back to, right? Because maybe affordability is there. I think it's an affordability issue, right? Like that's ultimately what it looks like to me, but you guys are the data experts. So we'll rely on you guys.
Yeah.
We'll rely on you guys.
We agree for sure.
Yeah, for sure. So, what's the problem with, like, obviously you guys are driving real-time data, but what's the problem with like lagging indicators, like, a Case-Shiller or something like that, where someone else would see some data? Like, what makes your data real time, so to speak, versus some of the other places we can buy that stuff?
Yeah, I think the biggest thing is the all-encompassing nature of the housing stack, right? So when you look at Case-Shiller, you're only looking at single-family residence, right? Which might be, a good indicator if you're looking at, potentially Dallas, Texas, right? Which has a lot of single-family homes, but it's not a good indicator for Miami, right? Where there's a large amount of condos, townhouses. There's only so much real estate that can be built upon, and so Case-Shiller kind of just ignores those properties, right? And so from our perspective, we think that real estate is, anything built on top of the ground, right? And so therefore our indexes do capture that real-time activity, right? And so the other piece is Case-Shiller's 2 months old, right? And even some of the other vendors that you might find available to you out there, they're going to present, prices to you a month old or sometimes even more. And so, we just feel like, hey, like the data's available, it's there. We can give you access to it. And on top of that, we can give you insights, like for example, like the mortgage information on any given home or the credit profile of a particular homeowner. And so, we just feel like that's really the value, right? Like, how could the largest asset class be the least liquid and the least transparent out there, right? We know more about the CEO of a publicly traded company than we know about, these like huge asset managers that own very, very large amounts of properties around the country, and what their portfolios are doing and how they're impacting our lives, right? And so we just feel like it's very important that everybody kind of has that transparency, can make really smart decisions, because, the reality is that for most Americans, this is the biggest asset they'll ever own. And this is where a lot of their wealth creation, and their hopes is happening, right? And so we think that good, important, and reliable, transparent data is going to be the way to move forward for people to make really, important decisions for their lives.
Yeah, absolutely. Now, flipping to the other side of the business for a second, I was just cruising through your website and I saw that, someone can actually open a deal with you guys for as little as $100. So you've made it really affordable too, to the barrier of entry down to where, everybody's got $100. They can invest with you guys. So what made you guys, decide that was the way to do it?
Yeah, I mean, back to that point, right? It's the largest asset class, the least liquid, and now the affordability problem in the United States. It just kind of speaks to the lack of accessibility, right? Like, we already kind of like skew, via culture everybody to kind of put all their eggs in one basket when they buy a home. A large percentage of their net worth is going to be tied to their house. They're very dependent on this house to consistently appreciate. And that's kind of challenging, right? If you live in these markets like Austin, where you did stretch yourself to buy a home, you're in Orlando, you're in Tampa, you're in Atlanta, Charlotte. And so from our perspective, it was like, hey, like you shouldn't have to put all your eggs in one basket. In fact, diversification is still important, even for anybody in real estate. And so we just felt like, hey, there needs to be an instrument that allows people to get access to real estate, and without the hassles of property management. We think that's very important, right? Because there are opportunities for people to buy a house, maybe fix it up and rent it out to somebody, but that's not going to come without some expenses or time, right? And so things will break, things will require maintenance. Tenants can be challenging for some folks in certain areas, right? And so that's also going to be very challenging. And so we felt like, hey, we need to create a product that allows people to get the exposure that they want, which is real estate, right, without any of the hassles. And that's really kind of how we started. We've gone through many iterations to kind of get this instrument correct from a risk management perspective and to allow people to deploy large sums of capital. And as I mentioned, we've done about $4.5 billion of total transactions in the last a little over a year and a half now. And so it's proven to be quite liquid for folks. And we just hope to continue to get the word out, help people understand like there's value in diversification. There's value in being able to access real estate without any of the headaches. And, we're not necessarily saying that people shouldn't invest in real estate, but, there's a time and place and an amount of money. And once you're there, maybe, the physical space is important to you, but there's a large amount of Americans that are completely priced out. Right. I think I saw a statistic where it's like only 40% of Americans can afford a $400,000 house. Those who can are already in a house. And so, that's an interesting statistic, right? And so that's a large percentage of our country that can access real estate. And we think they should have exposure.
I love this idea, Gus. Seriously, it used to be a time where hedge funds had the insights and everybody else was just playing guessing. And now that's not the case. You guys are literally leveling the playing field for everybody.
Yeah, that's it. It's funny, like roughly 2 years ago, we're working on the data and, kind of Open Door, it's on its way down and we got a lot of interest in specifically our information on the properties and portfolio for Open Door specifically, right? And that was from the hedge fund community and financial institutions that wanted to effectively get ahead of where earnings would be reported, right? And so we're seeing kind of the same level of interest right now with Open Door, kind of the run up it's had. It's obviously come down kind of from that $5 range, but that's what the power of transparency is, right? It's like, hey, like these things are publicly available information that we're going to make available and easy to consume for people, and they should have access to it. Open Door is a public company; they should be able to express a financial view based on publicly available information. And that's what we're trying to do. We want everybody to be informed, whether that's for financial gain in the stock market or for financial gain in the real estate market. We think it's important that transparency kind of lead the way.
Yeah. It's kind of like what you've been preaching the whole time. Right?
Yeah.
Data is awesome. And now, I think about the real estate agents listening to this call. You can use this to gain more listings or win listings because you now have heat maps. You understand pricing shifts. You basically got a lot of intel that you never had before.
Right.
And here we are with Gus and Parcl. This is outstanding.
Right. Yeah, I think, there's like a world of folks out there that maybe like turn a blind eye to this kind of stuff because it can be hard to get, right? And I think what's cool, I don't know if you know this, Gus, but we're actually a user. So Easy Street has an account with you guys. And we use it. We provide, use this data in part of our underwriting and analytics tool. And the data world is very disconnected, right? Like there's just like a zillion different places where you can go get different data types. And then you kind of lose sight of like what to rely on. And so we kind of started down that road, to be honest. We were buying like data from a bunch of different providers. And then our data scientists and I sat down and we started looking at like the data and comparing them. And we noticed that there was some discrepancies between the two. And now we're going, okay, well, like now we've got to figure out like who's got the best section of that data. And the fact that you guys cover a wide range of it, I think is super helpful to the user for sure.
Yeah. Not to mention non-disclosure states are extremely challenging to get good data on, right? And so we've built a few proprietary algorithms that have allowed us to kind of like, peel the curtain back a little bit in these non-disclosure states and get more transparency in there. But I mean, that's something that our customers are consistently coming to us about, like Texas, right? It's a market of interest right now. Non-disclosure state, hard to get a lot of information. And so, most definitely, right? And I don't necessarily have a view on non-disclosure or not, but to me, it just seems like, hey, like this should all be public information. This is a pretty important asset class for everybody to, have the information they need to make good decisions, especially as boomers are approaching retirement. They need to make decisions on should I sell or should I stay in this house?
Exactly. Well, let's talk about your open door use case a little bit, because I think that's super interesting. So tell us like what the community was reaching out to you guys about specifically on that. I mean, we not kind of know the story, Marvin. I don't know if you followed this at all, but Open Door just had like a run up stock, right? So their stock price just started going up, and as an early investor into that company, I was somewhat excited. I thought we were maybe going to rally a little bit. But maybe Gus has some better insights to that, because we've talked a lot about that company here on our podcast a bit. So shed any light on that for us, Gus?
Yeah, I mean, it's a meme. It's become a meme coin, right? And so the run up isn't necessarily driven by fundamentals. They report earnings on Tuesday next week, and so I think people should tune in, right? It's really a turnaround story. They're trying to turn this company around, right? By no means the imagination, or they're losing quite a bit of money. They're burning quite a bit of money, and so it's really a meme, right? Like that's why it's run up. And then when you actually look at their housing, they are selling quite a bit of their homes, right? But only 6% are actually at losses, right? So this is by no means saying like, hey, the turnaround's going well or not. It's just more so like, hey, they are trying to dispose of homes, right? They do not want to hold some of these assets on their balance sheet, right? But it's yet to become problematic for them, right? So like 6% of those properties are now being sold at losses. Maybe that continues to tick up. Maybe it doesn't. Right now, the listings don't signal, the listing prices don't yet signal that they're going to be losing on some of these properties. But that's been the interesting point. People are asking us for the specific listings information. And so we've added that to the front end. We've also added that to our API product so that people can do their own homework. Go in and go look at these listings. Do you think and project that some of these homes will go negative in a short period of time, maybe over the next 6 to 9 months? Maybe that enables you or influences your decision on what you think of the outlook of the company. But from like, what are they doing on the ground? They're not necessarily doing anything that's like particularly worrisome. They are cutting prices at relatively more aggressive rates than maybe your average homeowner. We're seeing this across the board on all institutions. We have a motivated seller index for every single house, right? And we also have that for institutions. Institutions are more motivated than your homeowners. They're cutting prices a little bit quicker, right? The reason is because they're all algorithmically kind of driven, right? So their algorithm saying, hey, we need to cut by this amount, at this frequency until we kind of find liquidity, right? And so it is interesting to kind of see this at Open Door. Do we have any signal on like whether or not that their turnaround story makes sense? That's kind of an operational problem and an operational efficiency thing that they're working on. But it has been interesting to get that insight on, well, they're not yet losing a ton of money on these listings, right? It's only 6% of the homes they're disposing of, but that could continue to tick up if they can't get these homes off their balance sheet. And so that's what people are looking into. They want to run their own projections on these like microeconomic environments in each pocket where Open Door owns some of these homes. And all this is available on parcellabs.com. So all you have to do is go to parcellabs.com, sign up for an account, and you can look at some of the aggregate data. And then obviously for our subscribers, we provide a lot more granularity down to the actual listing.
Wow, that's awesome.
That is awesome.
You're thinking about like, this company is potentially going to take a loss on some of these assets. All you got to do is go into Parcl Labs. You're going to have all the details, information you need in order to make that buying decision of like, should I target these opportunities? So very, very interesting there. So, what do you think's next, Gus? Like where do you see this market going? I mean, maybe let's unpack iBuyer first, and then we'll get into institution, and then maybe even into some tech. But where do you guys see the iBuyer world going next? It's proven to be a very difficult business. I think Zillow.
Yeah, it's extremely difficult.
Yeah.
And so there'll be some regional divergence, right? We saw this kind of like post-COVID, right? Certain markets did very poorly. California, right? Florida did very well. Texas did very well. New York did poorly. And so we're kind of basically seeing that regional divergence kind of play the other side, right? So now we're more bullish on Buffalo, Pittsburgh, Cleveland, Chicago, right? That Northeast Rust Belt. We're even now bullish on California and some of the markets in California. And now we're becoming bearish in markets that you would expect, right? So most Florida markets, with the exception of Miami, most Texas markets, Atlanta, Charlotte. And so some of these like Southeast markets that received a lot of benefit from COVID, we think are going to be, there's going to be a lot of motivated sellers. It's kind of like the way we're kind of like projecting this is, whether or not that means a large correction in prices, that really is determined by like, each individual seller's economics. Like, can they carry this home? Can they continue to carry this home? Is downsizing more expensive? That's something that we're looking into. So we're going to start doing some studies on age. We want to understand kind of like at a localized level, how old are these homeowners and when do we expect that they need to downsize? Because the boomer generation is quite large, right? They make up a huge percentage of our population. That could lead to a supply surplus, right? Which we have the supply shortage in all these desirable markets throughout the United States. But the reality is if these boomers begin to retire and downsize, there will be more supply on the market. And so we're very keen to understand kind of like what is the age relationship with these markets and these motivated sellers. So that's something our data science team is diving into. And then, as I said, these Northeast markets, the Rust Belt, Pittsburgh has been like an amazing market to own and even be like a landlord in, right? And so for investment purposes. And so we actually remain fairly bullish on Pittsburgh. There's still room there in that market. Buffalo is kind of like our the market that we're really bullish on of all markets. And so we just continue to see, our expectation is regional divergence will continue, possibly, a continued unwind of the COVID regional divergence we saw. And so that's ultimately like kind of how we feel. And again, these like bullish and bearish ratings are also on parcellabs.com. It's no secret. We're not trying to keep this from anybody. We want people to know like, how we feel about these markets. And then each market has a report where people can kind of get a better understanding of how our models work and how we come to these decisions.
Yeah. Sweet. That's sweet. What about so now with the institutions, right? They've been a little sleepy for the last, let's call it 3 years, right? Almost pencils down in a lot of cases. But it seems that there's some new interest in the market and, that there's some movement, at least a little bit. Where do you see that institutional buyer, shifting maybe even, through the end of the year? Do you think that we'll start to see some activity tick up with some of those guys?
Yeah, we wrote a report on this. So we did see a slowdown in Q2 of dispositions from institutions, right? So, we saw something like, 1,700 homes hitting the market and selling. That number went down to about like 1,400. And so we are seeing a slowdown, right? Again, we don't know if this is intentional or this is just the market is just slow to process transactions. They do happen to own properties in large quantities in stressed markets, right? So we're looking at like Tampa, we're looking at Atlanta, Georgia, Charlotte, and so some of these markets are already in distress. The institutions own not a negligible amount of supply, and so they could play a big role in kind of like correcting housing prices in some of these areas. But we are seeing a slowdown. I thought that was pretty interesting in Q2 compared to Q1 because my expectation was if real estate, if everyone's getting bearish on real estate, you would think that the institutions want to kind of get ahead of that, right? They want to get these assets off their balance sheet, right, and kind of like set the market where it needs to be before maybe mom and pop start putting listings on the market and downsizing. And so it has been interesting to see that slow down. Whether or not it continues is kind of like something to be seen. And so and whether or not acquisitions begin to tick up in other markets. And so right now it's pretty hard to tell whether or not like they're going to start deploying more capital. But we are seeing a slowdown in selling, and so maybe they think like a bottom has been hit. And so I think like it will remain to be seen. There are institutions that are more motivated than others. I think our motivated seller scores for institutions, just generally speaking, is about a 6 compared to a homeowner, which is 0.8. And so these institutions are motivated even though they're selling less homes. And so will be interesting to see kind of like where they see the bottom is, or if they just like decide to hit like the mass sell button and then just kind of find a floor quickly. So it remains to be seen. And then I think the other piece of the institution story is where do rates go, right? So like if we don't see this a cut in rates, or we have seen kind of a correction in the bond market over the last like couple of days, and so we're keeping a close eye on like is the market now expecting a rate cut on the back of these like job provision numbers this morning, and so it will be pretty interesting to kind of see like what do institutions do, right? Like their cost of capital is not the same as the mom and pop buyer at 7%, right? They get to manage their balance sheet in a much more efficient way, and so it'll be interesting to see if lower rates kind of keep institutions in the market longer.
Yeah, that's cool. Marv, I got a question for you.
Yeah.
Gus already gave away the number one market that they're bullish on. Where do you think, like, let's say 2 through 5? Let's go through those. Where do you think the next market is?
Bullish markets.
Yeah.
So
I'm going to bet you don't get any of these right.
All right, let's see. What are we going to do? 1 through 5?
1 through 5. I mean, just give me
How about no particular order?
Yeah, no particular order. Just
Atlanta's on there.
no.
Come on.
Nope.
Charlotte's on there.
Nope.
Okay, let's move on to the other coast. Let's see. Austin, Texas.
Nope.
Yeah. Let's see. Memphis. Come on. I got to get one right, Gus. I got to get one of these right. Gus is last. See, this is why I need the data insight.
I don't think you're going to get it.
You don't think so? All right. I'm going to flip it on you then. Go with. Ooh. Oh, I had it in my head. How about Savannah, Georgia?
Nope.
All right. Give me one.
Giving up.
You gave up on me.
Buffalo, number 1.
Yeah.
Cleveland, number 2. Milwaukee, Baltimore, and then Louisville.
What do they all have in common?
I don't know, Gus. You guys, you're the data. You guys have the data here. What do you guys, these are typically not markets that we would be bullish on, right? Where we see this kind of activity, but this is really cool information.
Yeah, it goes back to listings, price cuts, and motivated sellers, right? And so what we're seeing in some of these markets, they didn't get the run up post-COVID that some of the Southeast markets, like Austin. I mean, some of the ones you named are like markets that performed extremely well post-COVID. And I mean, Austin just last week was down 11%.
Yep.
Just to give you perspective, right? Like just last week, in 1 week time, and so which is incredible in my opinion. Like for an asset like a home to go down 10% just like that, like driving a car off a lot. And so what we're seeing in these like the Rust Belt, the Northeast, they didn't see a huge rise in home prices, right? And so there's this opportunity where homes aren't dislocated to income, and you don't have motivated sellers going crazy trying to get these homes off their own hands, right? If you go to Austin, the motivated seller scores are quite astonishing, right? Some people are like delusional in like the price they're setting and like how quickly they're trying to cut prices to even get the home off their hands. And so we're seeing a lot of this, and we even call them accidental landlords, right? People who are listing their houses, can't get it off, so now they're listing the rental property. So we actually see both listings at the same time. This is all over Austin. You'll see homes listed at $1.5 million for sale, but then for rent they're listing it for $4,500, and you're just like, well, that doesn't make sense. Someone's going to lose money here. And so it's very interesting. You don't see these kind of things right now in the Rust Belt. You don't see them in like the Northeast, like Buffalo, because they didn't get the run up in prices. And so we think these are going to be consistent markets at least over the next year. And if you look at like a place like Detroit, like there's actually affordable housing in Detroit. It might not be the most desirable of places, but people can actually like buy that home and increase their net worth over time by just being patient and investing into their own property. And so you'll see this across Cleveland. You'll see this in Pittsburgh's gotten a little bit expensive, right? It's had quite a bit of a run up over the last like year and a half, 2 years. But even that market remains affordable for people. And so that's really where we stand. People are not aggressively trying to cut prices to get homes off their hands. And we haven't seen this like huge dislocation in price relative to income.
And by the way, I got those wrong on purpose because this is the point. No, I'm kidding. I did not get it, but this is the point for those listening. I'm sure I wouldn't be the only one to get that wrong, right? And that's why you need data and insights. You see how I flipped that, Gus? You see how I did
completely.
That was awesome, right?
Yeah, you got it dialed in, man.
Yeah.
You definitely nailed it. So Gus, what do you see what's next? What's next for Parcl Labs? Like, where are you guys going next? You guys have a lot of data and information that you're sharing. And then obviously now you guys are helping out some customers with their acquisitions. Where do you guys see yourselves going next?
Yeah. And so what we're really focused on is we want to get closer to the portfolios, right? And so whether that's a mom and pop who only owns a few properties, there's about 900,000 plus individual owners of at least more than one property. It's between 9 and 99 properties. And so there's a large group of people who actually just need better tracking on their portfolios. We can help them better understand what's happening on the ground, if they should be able to get more rent for their properties. And so right now we're working on features to be able to upload portfolios, be able to get like very specific insights on your specific portfolio, and be able to help you just understand the market, whether you should buy more or whether diversification may make sense. And so that's really where we want to go. We want to get closer to the individual portfolios. We want to help investors really understand what's going on in their, in the properties they currently own, right? Where the opportunities kind of sit, as well as like, hey, diversification may make sense, or hey, expect this market to go down. There's a safety blanket there, right? Like at least if people know what's going to happen in the market, they can prepare, right? And so, that's the part of like real estate that's kind of like a unspoken, right? It's the unexpected things that throw off people's return profiles, right? And so we really want to help people kind of gain that transparency where possible. We can't help them predict whether or not vacancy is going to be like several months, but we can certainly help tell them like, hey, this market's going to, maybe pull back like 10%, like in Austin, right? Just like don't be shell shocked by that, right? Just so you know, that's an expectation. You're still, cash flow positive on your property. Just be patient. These markets kind of, do tend to kind of track inflation. We expect inflation to continue, right? And so that's just kind of how the economy works. And so that's really what we're focused on, is we want to get closer to the portfolios. We've really broadened our offering at the listings level. And so getting closer to the portfolios just allows more transparency for these portfolio managers to understand their risk. And that's really what we want to do.
I hope our audience goes over and checks out the website. There's so much like free information here too, and like just a ton of information. One of the ones that like I just stumbled on was the foreign owned properties and the drone threats to critical U.S. sites, right? So they're mapping like what properties are owned by foreign governments that are close to something else. This is pretty interesting stuff, like, and not a data point that like I've seen anywhere else. So pretty cool. Like I'm going to probably spend the rest of the day now poking around on here. Thanks, Gus, for taking up my day. But
that one was a really fun one, by the way. Like we really had a lot of, because we just started kind of exploring like what drones are even available. We didn't know anything about drones, right? We just knew that there was large concentration of properties owned by foreign governments, and so we started pulling up drones, and we're like, wow, these drones are all strategically pretty close to military installations. And so, that was just more of a fun one. And so we started finding other patterns, which, kind of becomes a little bit more interesting as to like, there might be opportunities to like help the government identify things that would be particularly interesting to them. And so that's the other power of our data, is we think that there's like a national security element there. But obviously I think like we want to focus on investors. We want to help investors. Obviously, when we find opportunities where we can help the United States government, we will. But yeah, that was a really fun one. The drone one was we all had a kind of a blast working on that.
Yeah, that's cool.
Real-time data just isn't an option anymore, right? Like it's ultimately giving you the competitive advantage. So if you're waiting on quarterly reports to make a decision, you probably already missed that boat and you're way behind. And so that's the big key takeaway from me today, Gus. So I appreciate it so much.
All right, man. Well, thank you so much. This has been fun to just, talk about something different today. So I appreciate you joining us here on Behind the Doors. And, hopefully our audience goes in and checks out Parcl Labs. I think, it's not expensive. It's not overly expensive to get it started with these guys and really get some unique insights to, properties in the future where some of the real estate opportunities might be. So
absolutely.
I love it. Thanks, Gus.
Yeah, thank y'all for your time. It was a blast.
Thanks for tuning in to another episode of Behind the Doors. We hope you found today's insights valuable for your real estate investing journey.
Remember, real estate success doesn't happen overnight, but with the right tools and strategies, you can build long-term wealth and create passive income.
If you enjoyed the show, be sure to subscribe, leave us a review, and share it with others who are passionate about real estate investing.
Don't forget to follow us on social media for more tips and exclusive content.
Until next time, keep unlocking new opportunities, and we'll see you on the next episode of Behind the Doors.